The biggest threat to the U.S. economy was never the AI bubble. It wasn't China, and it wasn't the guy sitting in the Oval Office either. It's something far more boring, something you've probably never even heard of unless you've fallen deep into the finance rabbit hole. And that's exactly the problem, because nobody's paying attention to it. If you've ever wondered why mortgage rates just won't come down, why the stock market randomly panics every few months, or why the Fed can talk all day about cutting rates while financial conditions still feel tight, the answer isn't sitting in Washington. It's sitting in Tokyo. Specifically in one of the most boring assets on the planet, Japanese government bonds. The same country famous for anime and weeb culture has quietly been the glue holding the global financial system together for the past 3 decades. And that glue is starting to come apart. To really understand why Japan matters this much, you have to go back to the early 90s. In 1992, Japan's massive asset bubble burst. Real estate crashed, stocks crashed, and the country slid into what became known as the lost decades. 30 years of almost no growth, no inflation, and barely any wage increases. It was like the entire economy hit pause and lost the remote. So the Bank of Japan did what central banks do when they've run out of options. They slashed rates to zero, then pushed them below zero, and when even that didn't work, they rolled out something called yield curve control, which sounds like a Marvel supervillain, but really just means we're going to cap long-term bond yields whether the market likes it or not. In short, Japan glued its interest rates to the floor. For decades, that meant Japanese government bonds paid out next to nothing, which created a real headache for Japanese investors. Picture yourself running a Japanese insurance company, pension fund, or bank. You're sitting on a billion-dollar portfolio, and your own government's bonds are handing you a 0% return. You're basically left with 2 options: accept getting nothing or take your money overseas. Naturally, everyone chose door number 2. That's how Japan ended up on a decades-long international shopping spree, becoming the largest foreign holder of U.S. Treasuries, one of the biggest buyers of U.S. mortgage-backed securities, and the world's largest net creditor nation, which is just a fancy way of saying Japan turned into the world's ATM. It wasn't because Japan had some special love for funding America, it was simply because the numbers worked out that way. Here's how it played out in practice. Say there's an investor, let's call him Bob, who wants to put his money to work. Bob borrows yen at near zero interest rates, converts it into dollars, and buys U.S. Treasuries yielding 4%. After hedging costs and fees, he pockets the difference. That's the yen carry trade in a nutshell. Borrow cheap in yen, invest in higher-yielding assets elsewhere. And when borrowing is basically free, investors don't stop at treasuries. They pile into tech stocks, real estate, emerging markets, anything that yields more than zero. For years, this trade became one of the biggest sources of liquidity in the entire world. At its peak, some banks estimated the yen carry trade was worth trillions of dollars. It was as if global markets were running off Japan's Wi-Fi. The whole thing rested on one assumption, that Japanese yields would stay near zero forever. That assumption broke in 2024 when the Bank of Japan ended its yield curve control policy and raised interest rates for the first time in 17 years, then raised them again shortly after. Right after that second hike, the S&P 500 dropped 6%, and Japan's Nikkei 225 plunged more than 12% in a single day, its worst one-day drop since 1987. Markets were officially spooked. When Japanese yields rise, 2 things happen. Borrowing in yen gets more expensive, and hedging currency risk gets more expensive too. Suddenly, that free money trade isn't free anymore, and Bob's 4% treasury yield doesn't look nearly as attractive. That was the beginning of the end for the yen carry trade because the math had flipped, and once the math flips, capital flows flip right along with it. Money that had been leaving Japan for decades started heading back home, a process known as repatriation. It's one of the biggest risks facing global markets today because investors are waking up to an uncomfortable reality. The world's cheapest source of liquidity for the last 30 years isn't cheap anymore. Here's why this actually matters. Japan wasn't just some random buyer of U.S. debt, it was one of the most consistent, price-insensitive buyers of long-term treasuries out there. And those long-term yields aren't set by Jerome Powell. The Fed controls short-term rates, sure, but the 10-year, 20-year, and 30-year yields are driven largely by supply and demand. The problem is that everyone's watching the wrong lever. Ray Dalio, founder of the world's largest hedge fund, explains it well. Watch the bond market. It's the backbone of the entire financial system, the risk-free or close to it interest rate that ultimately determines returns across every other asset. When supply and demand in the bond market break down, you see specific signals. Long rates rising relative to short rates, the currency weakening, and gold climbing because money is fleeing that imbalance. That pushes interest rates up and puts central banks like the Fed in a tough spot. So while everyone obsesses over Jerome Powell's press conferences like they're waiting on a movie trailer, they're focused on the wrong end of the yield curve. The Fed has some indirect sway over long-term rates, but what it actually controls is the short end, the overnight rate. The long end is shaped much more by supply and demand. And with the U.S. running trillion-dollar deficits year after year, even a small drop in demand becomes a big deal, since the Treasury has to keep issuing enormous amounts of new debt just to keep things running. Someone has to buy up all that new debt, and for decades, Japan was one of the main buyers absorbing it. Japan and how this could ripple through our economy. If one of the biggest historical buyers of U.S. Treasuries steps back, yields need to rise to pull in new buyers. That's just supply and demand doing its thing with long-term bonds. This is also how you end up with a strange situation where the Fed cuts the federal funds rate, short-term yields drop, but long-term yields stay stubbornly high, something known as a steepening yield curve. Once long-term rates stop playing along, this stops being just a bond market issue and turns into an everything issue. When analysts value stocks, they discount future cash flows using long-term yields as their baseline. If those yields stay elevated, the present value of those future cash flows shrinks, valuations compress, and stocks end up trading at lower multiples. So even if a company's earnings look fine, what investors are willing to pay for those earnings changes, which is why markets can suddenly feel shaky even when the headlines seem calm. And it doesn't stop with stocks. The 10-year Treasury yield isn't just some random number finance nerds track on Bloomberg. It's essentially the price of money and the foundation underneath nearly every asset valuation out there. Mortgage rates are a perfect example, since they're largely tied to long-term Treasury yields just like stock valuations are. If the 10-year yield doesn't come down in a meaningful way, mortgage rates aren't going to magically drift back to 3%. The Fed can cut the federal funds rate as much as it wants, but if global demand for treasuries keeps weakening, the long end of the curve stays pinned in place. And when that happens, mortgage rates stay high, housing stays unaffordable, refinancing slows to a crawl, and home sales stall out. The same story plays out in corporate credit, too. Think back to 2020 and 2021 when rates were artificially low and capital was cheap. Companies were issuing debt like it was a Black Friday sale on interest rates. Cheap financing meant more deals, higher valuations, and more overall activity, because credit is basically the bloodstream of the corporate world. But when borrowing costs stay high, the opposite happens. Risk appetite shrinks, growth slows, and capital dries up. And that brings us to the real point of this video. For 30 years, the U.S. benefited enormously from sitting on the receiving end of the world's biggest carry trade. And now that trade is unwinding. As Ray Dalio put it, the bond market is the backbone of every market, the interest rate that shapes returns across every asset class. What we're witnessing right now is a real, tangible force reshaping that very foundation. And there's a reason mainstream financial media isn't covering it. It doesn't make for good clickbait, and it definitely won't trend on Twitter. Nobody's rushing to click on, "Let's break down the cross-currency carry trade and how Japanese institutions are shifting their capital," because that topic demands patience, nuance, and a lot more brainpower than doom scrolling usually allows. People would rather hear about inflation, AI, or whatever Nvidia announced last week, the loud, visible stuff that actually generates headlines. So the narrative gets flattened into something overly simple. If the Fed cuts rates, financial conditions will ease. But that's not necessarily true. It's the comforting lie we keep getting sold. The idea that one rate cut solves everything, that liquidity just shows up automatically, that someone, somewhere, will always be there to buy our debt. But what happens if they're not? What if the largest foreign holder of U.S. Treasuries decides to pull back? Global liquidity tightens, and liquidity is essentially oxygen for markets. When it tightens, the cost of money changes everywhere, touching everything from stock valuations to mortgage rates to corporate credit, exactly like we've walked through here. That's exactly why I started this channel, to shine a light on the stuff that actually matters, the topics mainstream financial media skips over because it doesn't rack up clicks. If you want to understand what's really happening in financial markets, hit subscribe and turn on notifications because I'll keep covering the things traditional finance media won't touch. The real dangers in markets are rarely the loud, obvious ones. Those are usually already priced in. The real dangers are the ones hiding quietly in plain sight.